Good morning, class. This is your instructor. Today I'm going to be talking about the balance sheet portion of chapter 2 because I already did the introduction part and taught some of the elements of balance sheet which comprise of the accounting equation that we did in previous lectures. And the accounting equation basically deals with assets, liabilities and owner's equity. So it could be equity that is acquired through issuing of capital stock, and the part of equity which is basically dependent upon the savings that you put or inject into the business, and they are your retained earnings in the subsequent periods. So that means we are going to be talking about the basic accounting equation in the form of the balance sheet, and also going to be studying the effect of some portions of balance sheet and income statement. So there's a few examples that have been worked in this chapter, and this is also going to be helping you in the next chapter, which is chapter 3, and to solve the problem questions in chapter 3. So let's just begin with the learning objectives. As you can see that this is what we're going to be dealing with is this portion of the balance sheet and the LO2-4. And income statement has already been dealt with in the third chapter. So as you can see, okay, so now let's just look at the learning objective 2-4 and what does it entail, okay? So now it says that we have to deal with the balance sheet, and the balance sheet comprises of assets, liabilities, and owner's equity. So on the left hand side would be assets, and on the right hand side would be liabilities and owner's equity, right? So it says that we have to explain the statement of financial position. Now why do we call it the statement of financial position? Because although it would not completely reflect the statement of financial position, we also need to know about the cash flows, and I'm going to be talking about the cash flows in the next lecture. The reason why we need to understand about the financial position is because that would enable the shareholders to assess whether they want to invest in a particular company or not. So that means we're going to be talking about the incorporated businesses largely for which the mandatory requirement is that they need to have their financial position disclosed in annual reports. So that means we need to see their balance sheet, we need to see their statement of cash flows, and they have to be interlinked. And along with the income statement, now how do you link the income statement? Because you see, income statement would give you the idea about the profit, or the ability of the company to earn profit, and that profit can be injected back into the business in the form of retained earnings. So now the retained earnings can be routed into the balance sheet. So this is how you connect basically the income statement with the balance sheet. So if you make the income statement as has already been made in the previous lectures, then you will understand the linkage. So now this is the format. This is actually the T format. But I could also show you how to make the statement form of balance sheet beginning with the same things. But you just have to line them like. So I would say that instead of writing all these things in one line, you just simply have assets. If you can just simply see that I've written assets here, and then you can just have. Now there are current assets and there are fixed assets, okay? So in the statement form, you're going to be having something like this, right? And then when there's okay, now I'm going to be writing, this is let me just put it in a better way. This is balance sheet as at December 31st. Notice that over here they mentioned January 31st. That means this is opening balance sheet, okay? So this is opening. This is not the actual balance sheet. We need to find out what is the closing balance sheet after studying all the adjustments that have been going on throughout the year. So that could involve the operating activities, the investing and financing, or financial activities. So there are three kinds of activities that we're going to be talking about largely in the next lecture, but I'll be introducing the terms in this lecture, okay? So now this is the opening balance sheet because it's January, this is the start of the year. We need to talk about, but this is the month end. Remember this is the opening years, but month end, okay? So this is January 31st instead of January 1st. So we basically, when we make balance sheet, it's for December 31st of, let's say, 2019, because 2020 is the year for which the annual report will be available in the next year's March. So that would not be our concern at the moment. What has actually, largely passed us by, or it has is long past, we are going to be talking about that in the year-end report. So it's going to be something which is year-end, and 2019 was the year that was preceding this year, and we will be talking about that year. So first of all, we have cash, accounts receivable. Now notice that this is the main format. So you have cash, accounts receivable, tools and equipment, building and land. So these are very basic items in the balance sheet, but you have to be very careful in your placement. So it cannot be that you place one thing above the other. There has to be a particular precise format which you have to follow. So for instance, this apparent assets first of all in the statement version as well. So it's going to be cash worth, let's say it's 16,600. So I'm going to listing it as this. Then comes the accounts receivable, and whatever you write would be in the order of most liquid asset placed first, and the lesser liquid would be placed later on, right? So now accounts receivable in this case is lesser liquid than cash, although it can materialize within a month, but cash can be materialized immediately. So now this is 1,200, and also please make sure that you have the dollar sign placed at least one time, so that all the other values would be assumed to have the same dollar symbol. And then, now this tools and equipment is not so liquid, comes to or within the category of fixed assets. Okay, so this is, now FA basically means fixed assets, and they're tools and equipment. So not exactly fixed, but they're not exactly liquid assets. They're not current, and it's property, plant, and equipment. So this is fixed, and even though it is less liquid than property, but still it comes under that category. You place it under that particular group. So this is $12,000. Then comes building. That is $36,000. It's even better if you write the dollar symbol with each and every amount. It just looks neat, much better. But this is a bookish format, so they just place it one time, and it's also perfectly understandable and acceptable. Then is land. Land is the least of liquid. Okay, that means it's completely fixed and more than the building, because it never can be moved. The building can be destroyed, nevertheless. So we have $52,000. Now, notice that this is the T format, because this is T format, and in the T format, we usually have this as an imaginary line placed in the middle. If you can't see the line, I'll just have to darken it a bit. Now I hope that you can just simply make it out. This is just this T format. But instead of that, I would expect that you also learn how to make this statement forms neat and much better. So now you just add these up, and they would come to a total, and then you place another bar here, and then there's a double line. Okay, so this is a double line because this shows its total, the grand total. Okay, now you just add this, and I think that they have given us the total in this. Yep, we have 117,800. So just place it as in the statement form, just like this. Then come the liabilities. So now you notice that the liabilities are going to be placed here first, as does the accounting equation have all these. So now you have liabilities, you had the assets. So that means this was assets is equal to liabilities plus owner's equity. Okay, so this is the vertical form of the accounting equation. And notice the liabilities have notes payable, accounts payable and total liabilities would be $37,000. Now, since I don't have as much space, I'm just going to be writing all this directly. So liabilities come to about $37,000, but you are to write each and every element of item of this. So notes payable, I suppose, and then you have accounts payable. Okay. So it means that this total was 37,000. So you just add it up after placing them individually. Or as you can see, just let me just rewrite this 30,000. 7,000 comprises about 37,000. It's just actually, there's not so much space with me. And then you can have owner's equity as capital stock and retained earnings. Now owner's equity, in place here, as you can see, that owner's equity comprises of both the capital stock and the retained earnings. So it's just the capital stock, CS and RE as a short form, but you want to write it in complete form. And this is $80,000 and $800. Okay, so now if you know that there are 3 digits, so you're going to be placing it here instead of writing it here. So it's that you can't write 80,000 and then 800 here, okay? So it's going to be wrong. So what you're going to do is make sure that if there are 3 digits, place them after the comma. And the technique for putting the comma is that you would leave 3 digits and place the comma every time. So let's suppose if it's 2,000, then you're going to place a comma here. If it's 22,000, that's how it's going to be. If it's going to be 222, and it's going to be 1,222,000, then again after 3 digits, right? So it's after every 3 digits you place a comma. And now you just add these up as well, okay? So now the total would be 80,800 for the owner's equity, and can't see it really. I've just placed the total here, okay? I'm just going to mark a tick here which shows that I have placed the total here. Well, when you add these two, so this is 37 and this, okay? So when you add these two, 37,000 and 80,800, they would combine together to be equal to 117,800. So that means that this figure should be equal to this figure. Or in other words, the assets should be equal to liabilities and owner's equity, and this format is not flexible or amenable to change, okay? So it means that you have to just apply it the way it is, as it is. So now you have the notes payable and the accounts payable, they are both liquid. And then if there are long-term liabilities, if they are not, they're not really mentioned here, the long-term liabilities, but if there are long-term liabilities, then you just add them after the short-term liabilities have been written or placed here. So now you can have the short-term and then long-term, and then you have the, okay, now the students also confused in the terminology. Sometimes they would write, short-term assets and long-term assets, so there's no such term. You don't write short-term asset and long-term asset, instead you say current assets and fixed assets. And you also don't write long-term assets, even though they are long-term, especially fixed ones, but you don't write it like that, okay? And similarly, for liabilities, you have short-term and long-term. Now, what is the justification? Because short-term basically means that you have taken a loan, or you've taken some kind of overdraft facility, some credit facility, and you have returned that money within within one accounting period. So this is of 1 year. So this is going to be approximately, most likely, or at most, it's going to be for 12 months, but can be lesser. It's 3, 9, 6, anywhere within 1 year, right? But so for the notes payable, it's just a promissory note where you would be promised, if someone else is giving you the promissory note, that you'll be promised that you will be paid. But if you are paying someone, then that is notes payable. And that notes payable would be like a promise from your side that you would be paying the particular person after a period of 3 months or 2 months, along with some interest, and that is a promissory note. And the date will be mentioned at which it is going to be paid, and the date at which it was taken, and the person who took it will be signing that note, okay? And the accounts payable is very different from notes payable, because accounts payable means that you took inventory from some supplier, but you did not pay him. So there's a difference between factory supplies and wholesale market and then retail market, because the retailers would essentially buy from the wholesalers, and the wholesalers would be taking them from the factory. So accounts payable would be when you have to pay the people you have taken the inventory from to sell later on and then give them or recompense them for whatever you took from them, you do that later on, okay? So for instance, I would say go to a 7-Eleven, go to Zellers, and they would have some milk products there, and some of the milk, if it goes bad, or eggs are placed there and some of the things go bad, then they would return it to the supplier, stating that this went bad. So they won't be paying the money for the items that they took. So that means that accounts payable includes inventory for which payment is due. And if it concerns with services, then you would hire staff, but you would be giving them salaries later, something like that. So for accounts payable, usually for services sector is quite different from manufacturing sector. When we talk about accounts payable, usually it means the inventory, and if it is accounts payable for, let's say, services, it means that if my educational institution has hired me and they have to pay me, they have hired a group of people, the trainees, and then that would be accounts payable in a way because they have taken expertise and they are selling their services to other people and they have collected revenue. So for instance, if they say they have, let's just say that they have hired a staff, and the staff is, that particular staff is training a group of students, and students have paid them fee. So now those people have actually conducted that training session, so that person is due some amount of money for which he actually gave that training. Then whatever he has to be paid is actually adjusted against accounts payable, because it's not a salary, because it's just not something that he is regularly doing, because salaries payable would be something different for services sector. But accounts payable is usually when you have some products. So if you have someone else being hired, and that is something that you do on and off, then you can also put that under accounts payable, but it's rare rather. You usually use this term for manufacturing concern, or even for sometimes the merchandising sector as well, because you make purchases and then you sell them, okay? But for manufacturing, you would just manufacture that thing as cost of goods manufactured and then you sell them. So this is how it works for balance sheet. Now let's just go for the equation. I'm going to be rubbing this off. Okay, so now we have this is the equation for a balance sheet that we're going to be talking about. Let's just look at this example. So now, as you can see that statement of financial position, this is assets is liabilities plus owner's equity, and now these are the following dates have been given to you. Let me just enlarge this so that you can see it. Okay, so you can also open your books at 2-4 learning objective, and I'll just read it out to you. Perhaps you might not be able to see the entire content. It just says that Michael Bryan started the business by depositing $80,000 received from the sale of capital stock. Now, this is a very common example. I've already done that before in previous lectures. But what you need to understand is that when you deposit something, it was through some source. You don't just get money out of thin air. So if you have issued stocks, then people are going to actually invest in those stocks and give you money for that, right? So the $80,000 that he has deposited inside the business, it means that he received them through some source, and that source was the shareholders. So this is the general entry, the general journal entry would be cash debit, and capital stock would be credited by $80,000. So now how do you show that in the accounting equation? The same thing is visible if you just go down a bit, and you can see it in red, right? Now this whole thing, and the similar question is given to you in chapter 3. Problem 3.1 is perhaps related with this. So if you just listen to this or look at this very carefully, just want to zoom for you. Oh yeah, so okay, so I think it's at least visible. The red color is at least visible to you. Now, $80,000. I was speaking that when you invest in shares, it means that somebody issued those shares in the first place. So now, if the company has issued shares and you are talking from the point of view of the company, you are not talking from the point of view of the individual. So, if the company issued, because the company needed funds, and the easiest source of funds is to issue stocks instead of taking a loan, because loan would incur interest, and the companies largely avoid that because the high cost of debt involved, and that can affect the operating cash flows. So now the entry was that cash was debited and capital stock was credited. So now you can see on January 20th, cash is debited, and that's the opening. Now you have either this is the opening cash, so this is the January 20th balance. So you can just treat it as the opening balance because that was the start of the year. And now you can see the red. Now this red basically indicates the transactions that are in effect. So it means the black ones are going to be either the totals, and they are the benign transactions, because the red ones are the ones which are actually impacting the accounting equation in this situation. So for the January 20th balance, as you can see, the balance would be 80,000. This is black, but the red one basically indicates that this is the active transaction that took place, that you had the cash and you had the capital stock credited, so now that is also active. So for January 21st, now let's just see what happened. Now for January 21st, purchased land. Now let's just see that you purchased land for, okay, let me just read a couple of them, then you can just place them in your memory, commit them to memory, and then you can just recall them. So you have purchased land for $52,000 and paying cash. Now be very careful in this. Had they not mentioned the word paying cash, you would not automatically assume that they paid cash. If they don't mention, they just say they purchased land, then you would assume that they did not pay any cash because they have not mentioned so. So in accounting, you have to be very particular about what has been mentioned and what is implied and what is explicit, right? So if they have purchased land, now they say that it's paid for, then that means you're going to subtract this. So you can see that there's going to be a minus 52,000 from the 80,000 that you initially got deposited. Then the next January 22 is purchase a building for 36,000, paying 6,000 in cash and issuing a note payable. So that means for the remaining amount, you had the 30,000, you had the notes payable. So what would be the transaction? So it's going to be 36,000 debit for land, okay? You're not going to be debiting cash in this because you obtained the building, sorry, not land. Building for 36,000 and crediting with cash $6,000 and notes payable for $30,000, and the accounting equation will be effective. As you can see now. Alright. So now you see this is January 21st, and we have $52,000. Subtract, this is a minus sign here, okay? So you just open your book alongside so that you can actually see, because this is just very minute figures. It's not possible to enlarge them too much because they will just cover the entire computer. Let me just actually temporarily enlarge this if I can, just for you to see it one time. Yeah, so I hope that something is visible at least. So now, this, as you can see, this is $52,000, right? And there's subtract, this is a minus sign here. So now, the first balance was 8,000, and you can also make a ledger out of it, and then that ledger can actually have the balances, the closing balances that are transferred to the balance sheet. And in the balance sheet, which is the closing balance sheet, you'll always have the closing figures after all the adjustments have been accommodated and all the adjustments have taken place. So now you have $52,000 subtracted from 80,000 and you get about the balance is 28,000. But this balance up till now is the closing balance for cash. Okay. So since you purchased this amount with cash, you're gonna subtract the entire amount. And what did you get from this cash? You actually had land. So you're gonna add with a plus sign on this land. Okay. So now do not place this 52 here because the transaction took place on 21st January, right? So now this is 52,000. The balance is actually 52,000 because no further transaction for this particular piece of land is taking place. It has not been disposed of as yet. Then you have the total balance is $50,000 again. Now on January 22nd, what happened? Now partially cash was paid for $6,000. So you're going to subtract further 6,000, and you get 22,000. Okay. So from 80,000, 52,000 was spent for land, and then further 6,000 was spent in the way of purchasing the building. Now the remaining was notes payable. As you can see now, the asset increased by $36,000 in the accounting equation. So now the left hand side has to be equal to the right hand side. So now in this case, even you can say that cash was reduced. So it's not always necessary that if on the left hand side you can see something happening, then on the right hand side some effect has to take place. It could, or it might very well be that one effect, both effects could be taking place on the left hand side. So there could be an increase in one asset and decrease of equal amount in the other asset. So this is going to be, for instance, you purchased one asset, land, but you reduced the other asset, cash. So the net effect was 0. So 52 minus 52,000 is 0. And similarly for the next transaction, since the cash was partially used and the building was for 36,000, so now something has to equate. So now this is asset of 36,000 for which you purchased one asset and you reduced the other asset but in unequal amount. So that means the cash was reduced to only 6,000. So now you need to balance the remaining 30,000, and on the other side you can see that this is 30,000 as notes payable as red, and then this is the only amount that is occurring till now, till the end. This is the final amount which will be for the land, for the notes payable will be occurring in the balance sheet. And this 80,000 is the same. It will be occurring in the balance sheet as capital stock of 80,000. As you can see in the balance sheet, if they have shown the balance sheet actually. Let's just see. So now in this balance sheet, as you can see that the land was purchased for 52,000 and cash was gradually reduced to 16,000 because I have not done the entire adjustment for you. You have to do all the other adjustments yourself, but it's very important for you to understand that the cash was remaining 60,600. How was it remaining? I'll just show you in a while. But as you can see that land was 52,000. The building was purchased for 36,000. Tools and equipment was 12,000. Accounts receivable 1,200. And notes payable was 30,000, as we just saw a while ago. And we also have the capital stock as 8,000. And then you can, there are further other transactions that you can just simply tally. So the balance sheet, the closing balance sheet would actually have all these figures placed inside. So the opening would have been January 1st. Since they just made, for simplicity, they made this balance sheet as the closing for 1 month. But we usually do not make it, or not just usually, but never make it for 1 month. We always make it for 1 whole year, because that is the statement of financial position. But we can also show for sometimes intermittent financial statements like the quarterly statements, the semi-annual statements. We can see, we can show the balance sheets. And this is for our own personal record. You don't have to show this in the financial statements for every month. You don't make financial statements for every month, and you don't show it on a monthly basis. So this is just made annual. This is just for the internal report of the company. And let's just look at a few numericals. Let's just see. Just see if I can have some. So you got to do the demonstration problem yourself. So now, as you can see, that this is the demonstration problem where you have account balances for crystal or wash. It's just at a glance problem that you can really understand well. I hope you can understand, see this. What they are basically trying to show is that there's a crystal or a wash at September 30th, as shown as follows, and the figure for retained earnings is not given. But it can be determined when all the available information is. So now you have to basically find out the retained earnings. So it's just very simple. This is the accounting equation now. You have to find out what to be placed where. So now, first of all, you find out what are the components of balance sheet for asset side. This is the component for asset side that. Okay, so these three ticks would count for the asset side. Then you have land, machinery and equipment. So these are basically, to some extent, the supplies they have not been consumed. So you also have to look at the adjusting entries. And the capital stock is, and this part is the owner's equity. Okay. So you can just simply, for your own ease, you can just simply say this is the asset side, this is the owner's equity, this is the liability side. So that's accounts payable, notes payable, this is short-term notes payable, and then you have salaries, it's all current liabilities, okay? And then you have owner's equity. So how you're supposed to find out? First of all, you add up all the assets. And then you are going to subtract the liabilities, you add up all the liabilities. So even if on these, if the statement form is to be made, then you can just simply write cash as 11,040 and so just balance sheet as at December 31st, 2009, just for ease sake at the moment. Now this is the current assets. You don't have to label as current assets, but this is the way things are. Chronologically, you can say, or it has to be the most in the order of the most liquid asset placed first. So then you have accounts receivable, and this is 960, let's say. I'm assuming there are no further adjustments at the moment because it's simple balance sheet. And then you have inside is building. Machinery and equipment will come next. Machinery and equipment is $78,000. And you have then building. So now this would be fixed assets in a way, or non-current assets. Okay, so this is building. Would be, if the term non-current comes, it's the same almost. Okay, the only difference being that non-current would be intermediate between fixed and current. So equipment is sort of like a non-current one, it's not exactly fixed. So you can't really term it as fixed, but this is also non-current assets, okay? So machinery is, since it's fixed, but the equipment is usually not fixed, okay? So that's why I'm using, you can just use both of these terms. So now building, and then you have building. And what else is there? We have land. And land is approx $81,600. Then you have machinery and equipment is done. Okay, now you just add up all these assets and you get a value, okay? So then you have liabilities as accounts payable. These are short-term liabilities, so accounts payable. And then there's notes payable. Okay, so the accounts payable is 16,800 and notes payable is 34,800. And then you have salaries payable, and they are 3,600. Sorry, I forgot to put supplies. So you can also have supplies placed somewhere here. They are provided that they have not been consumed. If they are consumed, then you won't write them here because then they will turn into expense. So let's just see that this is 3,600 and you have, I think, pretty much covered everything except for the owner's equity. So now then comes about, this is the next portion, which is owner's equity, and you have capital stock of 120,000. So what is the retained earnings? It's just X, okay, just place X, subtract everything from the asset side. Now, when you have short-term liability, you can also place a single dash. Double dash would mean the total of all the liabilities. This double dash is grand total. And now we can just add these up, and you can also see the T count version of this, okay? So now what they have done is like this. Let me just okay, so now you see that this portion would have the cash 11,040, accounts receivable as 960, supplies as 480, provided that there's no adjustment regarding the supplies, okay? Because supplies get consumed and then they become expenses, and expenses are not placed in the balance sheet at all. So now then you have machinery and equipment as $78,000. Then you have, now this is, let's just see. Okay, building, machinery and equipment is $78,000, and building is $62,400, and land is $81,000. So the total would be $234 and $480. Okay. And the liabilities now, as you can see, all the contents or the components are the same. Now you see that this is liabilities are notes payable, accounts payable, and then you just write, first of all, if it is within 30 days, then you can just place the notes payable above and accounts payable below. It depends upon the accounts payable's accounting cycle. So if have they mentioned it in the question how long the accounts payable cycle is, then it's very convenient for you to understand. But I think they have not particularly mentioned, so you can just place it any way you like. But since they have particularly mentioned that notes payable is within 30 days, so you can just place it above. But sometimes the notes payable can be of 3 months, 6 months, so on and so forth. So then it also depends upon the question. So now in this case, you just assume that both are the same, so you can just place either of them above or below each other. One is above the other. Okay. So now then there's salaries payable, again 2,600, and then you just add these up. Okay. So now you will have the total liabilities as a double dash. Okay. So this is going to be a double dash here. There's going to be a double dash in here. So let's just, first of all, let me just place the double dash here, and I can have 55,200, even though they have not mentioned, but these are the total liabilities. Now understand, there's a short-term liability and the total liabilities are the same, but if they are not the same, then you just place a single dash. Okay, let me just repeat that if the short-term liabilities and the total liabilities are the same, you place a double dash. But if the short-term liabilities are not equal to the total liability figure, then you place one single dash and not the double dash, okay? If they are not equal. But if they are equal, then you place the double dash. Similarly, now you can see that the capital stock is 120,000. So now capital stock you can just place just below, and you can have 120,000 here. But now you don't have the retained earnings, so you can just simply from this 234, you can subtract this part, minus 55,200, and then minus 120,000, okay, just the way they have actually showed in here. So the remaining amount would be 234, 480, minus 55,200, minus 120,000, okay, and the remaining balance would be around about 59,280. So see, this is the assets total side, which is 234, 480 minus 55,200 total liabilities, and you get the remaining balances 179,280. And then you subtract the capital stock and you get 59,280 balance, and that's the retained earnings balance. And I wanted to actually do some of the numericals with you. I think I'll have to do that with the cash flows next week. I'll be explaining to you the cash flows, but won't be doing any numericals for cash flows. And I'm going to be doing the numericals for balance sheet and income statement 2 to 3 numericals for balance sheet, and I think one for another income statement, which is possible. Otherwise, just balance sheet and introduction to cash flows. So guys, it's just I hope that I can actually do one numerical for ease sake. Let's just look at exercise. Okay, so this is, I've given you a few questions in assignment. Yeah, till 2007. So let's just look at this question, for instance. I'm going to be rubbing this working off. Okay, so now the question is about Spencer Software Company has assets of $102,000 and liabilities of $552,000. Prepare the owner's equity section of the company's balance sheet. It's very simple. When you have to prepare the owner's equity section, you first of all write down the accounting quotient as assets equal to liability plus owner's equity. Now this is X, so you just simply A minus L is equal to X. This is the formula that you're going to be using in this question. So now this is 102,000 and 552,000. Now the first part is the business is organized as a sole proprietorship, and the business is organized as a partnership. Spencer's equity amount is $288,000. Okay, so let's just 102,000 minus is 552,000. And then the other figure is 288,000. And then you have this organized part of the business corporation 27 into 12,000. Okay, 12,000. Okay, now let me just read the question to you. So now first of all, the business is organized as a sole proprietorship concern and is owned by Johanna Spencer. So now they have asked you to basically inform about the owner's equity section. So part 1 would be just simply this accounting quotient as assets minus liabilities. So now what I'm going to be doing is let me just calculate the value for you. So if I open the calculator somehow, I can just open the calculator. This is 102 less liability is 552, and you get 450,000. Okay, so the total in this case is 450,000. This is the value for which the total owner's equity is had there been this one sole proprietor. But now, as you can see that if it is a partnership, then this value will not be the same. So let's just assume that this was subtracted with, this is, sorry, 450,000 subtracted with 162,000. Okay. So let me just also solve this in a way that they asked us in the first part 1, that if the equity is limited to one person, then you know that assets is equal to liabilities plus owner's equity, and since the assets are 1020,000, so therefore for part 1, the answer would be minus, this is going to be $552,000, and it comes to about $450,000. So this was our primary calculation for sole proprietorship concern. Then we had in the next part, if it was a partnership concern and this was the total equity, then partnership in which the person has 288,000 as equity, then the other partner would have how much? So the other partner would be left with 450,000 minus $288,000, because that is the equity of the other partner. So they have given you the equity of the other partner, but you have to calculate the equity for the first partner, which is Spencer in this case. So now, how much does that become? As I calculated something close to about $162,000. So now you just have this as $162,000. Now the third part is slightly requires the attention. Now this says that the business is a corporation. Okay, now let me just run this. Or let me just read this for you. The business is a corporation with 27 stockholders, and each of whom originally invested $12,000 in exchange for shares of the company's capital stock. So each invested $12,000. So how much was the total investment in this case? So if there are 27 stockholders, each invested $12,000, and actually the total investment would be 27 into $12,000, and that would be how much? So just simply multiply this. The remainder has resulted from profitable operations. So now, okay, so this is very easy. Just simply 27 into 12,000, and you get about $324,000. So now that means that what you are essentially looking at part 3 is, now the part 3 would have 27 stockholders, each investing $12,000, would come to about $324,000. That would be the total equity for the from the point of view of the investors. Now the total equity was $450,000. So now they want to know as to how much was the profit of the business and how much was the equity by the shareholders. So now the total shareholders' equity was $324, and what was the profit of the business? So now this was actually profit by pi is actually the profit, and that is equal to $450,000, and then minus the $324,000, and the remaining amount would be the profit. Okay, so you simply subtract the $324,000 and $450, and you get about $126,000 was the profit of the business. So the $126,000 in this case was the profit of the business, and if you want to write it in a better way, it's just you simply say that the profit actually would be the share total equity, business equity total is $450,000. Shareholders equity is $324,000. Subtracted, you just place a bracket here, and then you can just simply write that this was $126,000. This was the remaining profit of the business, okay? So here you're done with the question, but there's another part in this question. Now the part is that assume that you are a loan officer at Security Bank and Spencer Software Company has applied to your bank for a large loan. So you assume that you are a loan officer and that they have applied to your bank for a large loan, that you work in a bank as a credit officer. So to finance the development of new products, so does it matter to you whether Spencer is organized as sole proprietorship, a partnership, or a corporation? Yes, it does. Why? Because if it's a sole proprietorship, the liability would be entirely upon the owner of the business. If he's not able to pay it, you're lost. Partnership, it would be divided between two partners. So then he's more in a capacity to pay his part because it would be a divided liability. And similarly, in a corporation, there are millions of owners, and it's very likely that if the loan is not, returnable, or is not, the company is not basically able to pay that loan or just that, so that corporation can be dissolved to give back or liquidated in this way. It goes insolvent. It's no more a going concern, and the bank would be able to get that, what it basically lent. And here I will be concluding my lecture. So see you guys next week, same time. Thank you so much.